Good morning, everybody. I apologize for the technical difficulties. If you can hear me, I was getting some pop-ups and some emails from folks who said they couldn't hear us. So if you can hear me now, if you drop something quick in the chat box just to let me know that we're live and you can hear me, and we'll get going on this right away and try to run through here fairly fast. But so today we're going to talk about 5 mistakes that could cost you $10,000 or more. And I'm going to point out that these are strategies that are not put a bunch of money in your retirement account, not where I'm going to have you spend a bunch of money in order to save a little bit of it. These are all things that are very cash flow positive. So I'm going to go ahead and get moving here. So in the meantime, if anybody has any comments in the chat, please go ahead and add those there. So anyway, today's agenda, we're going to go through the mistakes. Mistake 1, wrong entity structure. Mistake 2, over or underpaying yourself. Mistake number 3, not knowing changing laws. Mistake number 4, doing it yourself. And mistake number 5, failing to plan. And then we'll have some time for some Q&A at the end of the presentation. So mistake number 1, wrong entity structure. And we see this fairly regularly where someone has formed an entity under state rules but has not completed or taken into account the tax ramifications of that structure. So, and a good example here is the LLC. The LLC under state law, is a entity. You can form an LLC, you can form a corporation, you can be a partnership, and the LLC can be treated from a tax standpoint just like a partnership, or just like a corporation, or just like an S corp, and you get to pick those. There are some defaults, and if you don't complete your setup, then you could end up in the wrong structure. By default, someone opening a business that doesn't form an entity is usually a sole proprietorship, and they get taxed on their personal tax return as a sole proprietorship. So I think the key here is making sure that you understand what you're trying to accomplish. A lot of times the difference between what entity we want to be and what entity you may be is us understanding your type of business that you're running, whether it's an active business or a passive business. Active being a running business with an active customers, versus a passive business, which is rental and investment types businesses. So usually based on size and purpose of business is really how we determine what is best for your situation. Cost to maintain, we always look at the cost and benefit of any structure to make sure that your benefit exceeds your cost. And a lot of times we will talk people out of forming certain types of entities because we don't think their business is there yet. And a lot of times that cost to maintain is paying us. So we'll say, hey, you don't need to do this entity yet, you're not big enough, and it's going to cost you more to pay us to do a tax return than you're going to get in tax savings, so don't do it. What could it really cost you is a matter of how much income you're making, what types of income you're making, and how wrong your structure is. So one solution that we offer is we prepare proactive tax plans that involve reviewing the structure and changing the structure when necessary, and most of those save $10,000 to $15,000 a year in various types of taxes. I'll give you an example. We did a plan last week for a couple that has a business that's paying them right now is on a 1099 just to their name as a sole proprietor. We suggested that they make the change to form an LLC, elect to make it treated for tax purposes an S corp. It involved, creating reasonable compensation in the form of salaries, and also, retirement plan contributions, which, usually come last in my plans. I like to include it because, sometimes we can double down when with the tax savings we make in the one step, we can use that to make contributions to a retirement plan, which you save, obviously for your retirement, but also get a tax deduction for that. So in this case, the creating the LLC and making it an S corp is going to save them $20,000 a year in mostly Social Security, Medicare type taxes. And they're going to save another $19,000 a year by fully funding retirement plans. So, all in, this structure, which could cost them, a few $1,000s a year to administer, is going to save them, almost $40,000. And, that's a good return on investment there. Mistake number 2, over or underpaying yourself. So both overpaying and underpaying are problems. Generally, the IRS likes to see corporations and S corporations pay a reasonable compensation, and reasonable compensation isn't very well defined, but it's more of the lack of it is something that's a problem. So if you're an S corp and you're running an active business and you're making $100,000 a year and you're paying a salary to yourself of $0 or $10,000, does that seem reasonable? So, a lot of times we'll look at the job title of the person, what they do every day, how much of it is, high level stuff, how much of it is low level stuff. So we may have an engineer who, spends 30 hours a week on engineering at a high level, but he spends another 10 hours a week on administrative functions. So, we can argue that he shouldn't get paid quite as much as someone who's working as an engineer full time in a company that doesn't, where they have admins and he doesn't have to do all those things. So on the C corp level, a lot of times they argue that, compensation is too high. We don't run into that an awful lot. Usually it's too low on the S corp side. So then when I say compensation, I mean payroll. So wages, the stuff that's subject to Social Security, Medicare, and unemployment taxes. So underpayment problems. If you're not paying wages, you're not paying in Social Security, and you're not paying in Medicare, and you'll have reduced or no Social Security on deposit when you get to retirement age and you turn to the Social Security system. You also base your retirement plan contributions on your earned income. So you may have an S corp that makes $100,000, but if you didn't pay yourself any wages, you can't put any money into your retirement plan account. You also have the risk of the IRS coming in and saying, well, you made $100,000 and we think that should be reasonable compensation. Now you owe us 15% of $100,000 for the last 2 or 3 years because you didn't actively determine your own reasonable comp and start paying yourself wages. The other thing we saw this year, it's my special COVID-19 issue, is if you didn't have payroll, you couldn't get a PPP loan. And if you didn't have payroll and you weren't paying into the unemployment system, you could not get unemployment benefits. And, we do have, this year being a very odd year, we do have business owners who are, laying themselves off because their customers have laid them off and have gone on unemployment. And if you don't have the compensation, then you're not going to show up on the unemployment, and you're also not going to get like I said, the PPP loans were a problem for people who underpaid themselves. I'll also say loss of QBI deduction. The QBI deduction is a business deduction that came from the 2017 Tax Cuts and Jobs Act. I don't want to get too deep into this, just suffice it to say that there's a balance between profit of your business and the amount of wages that you pay. And if you do it wrong, you can lose out on this deduction, which is a very lucrative deduction. Overpaying problems. So You can, again, depending on the level, you can be overpaying in Social Security, you can be overpaying in Medicare, and the extra Medicare, the Obamacare Medicare, which is an extra 0.9% once you break over $200,000. There's the loss of the benefit of the S-Corp distribution, which is, again, a lot of times why we use S-Corps to break up the salary and the company profits into two different buckets, which allows us to minimize perhaps Social Security, Medicare, and extra Medicare, and create a sweet spot with the QBI deduction. But you can lose those benefits. We've also seen where you've been unable to use a loss created in a business. So we've had clients over the years who overpay themselves to the point that it creates a loss on their business just because their payroll was so high. They get taxed on the wages, but because their business didn't have any basis, they couldn't deduct the loss. And that obviously is not a very well planned out scenario for anything. I'll point out and there's also the loss of the QBI here, which is again a sweet spot that we like to try to find in that wage versus non-wage when we're dealing with S-Corp. So I've got a couple of different examples here. One, we had a guy in the boating industry who gets paid a 1099, and he just everything he paid himself, he paid his wages. When we did a tax plan for him, we reduced his wages, and reducing his wages means there's more profit to the company, which then of course allowed for the QBI deduction, and tweaking that saved him about $9,200 a year in income tax. And Social Security, Medicare, and the extra Medicare tax, because there's it was all of those things. So we had another individual. These were both in 2018 actually, because the Tax Cuts and Jobs Act of 17 took effect in 18, and it created this QBI. And we had an insurance agent where we cut his wages in half and saved him. It was about $20,000 a year going forward on that combination of the Medicare and the extra Medicare for a self-employed person works out to be about 3.8%. So I think we reduced his wages by about $200,000, and it saved him almost 4% of $200,000 just in that. But it also created the ability to deduct or to get a QBI deduction on his $200,000. So that's a $40,000 deduction in his tax rate there. So all in was about $20,000 a year savings by tweaking this. So we want to be very careful of that. And again, it's unfortunate. For good news for us is that these were both new clients for us in 2018. The bad news was they lost the benefit of this in 2018 had they been looking for this and planning for it in advance, which brings us to mistake number 3, not knowing the changing laws. So obviously the tax rules are always changing. Annually the IRS releases revised amounts for retirement plan contribution amounts, which you can put in, standard deduction, mileage rates, tax brackets, per diem rates, and a bunch of other things that, not everybody uses these every year, but you need to be paying attention to these, because if you're putting money in your 401k plan, you want to make sure that and you're maxing that out, you want to make sure that you adjust your contributions every year so that as that goes up, you actually get to put the higher number in. And then also there's the laws that pass. Every Congress is always up to something. So every year or 2 or 3, we see tax laws. So the Tax Cuts and Jobs Act of 2017 was a major change. It created the QBI. It also changed the way you could no longer carry back losses. There was a whole bunch of things in there. It eliminated the deduction that some employees used to get for the unreimbursed employee expenses, and changed the tax rates and a whole bunch of other things. So when something like that comes along, you tend to hear about it, but some people just don't pay attention to it. So the Secure Act, which was last year, it changed when you have to start taking required minimum distributions out of your IRAs and 401k plans. I changed that to 72 instead of 70.5. And then, of course, this year, the CARES Act, and then there's been additional legislation, and I expect more this year. I expect this to be a pretty busy year for new tax rules. Created the PPP loans and some other things. So, as I mentioned before, our insurance agent and our marine worker, they lost out on those savings in 2018 because nobody pointed it out to them. We did their 2018 return in 2019, and we realized there was a problem. They were new to us that year. I don't feel like that was our responsibility, but definitely, someone should have been reaching out and saying, hey, what's, some things have changed. And, we regularly reach out to people when things change, and not everybody responds. So just be aware of that stuff. Mistake number 4, doing it yourself. So we see big problems when we encounter, new clients that come in who have been preparing their tax returns themselves, and they get to a point where they say, this is just too complicated, I don't want to do it anymore. And of course, the problems we usually see are with depreciation, wrong entities, not understanding the passive loss rules as it relates to real estate investments, determining what is and what isn't deductible. If you don't know those rules, and certainly TurboTax will let you put some of that stuff on your tax return, and it doesn't understand what you're putting in there. Screwing up your payroll, the penalties in payroll can accumulate pretty quickly. We don't suggest people handle most payroll themselves. We use different payroll providers that will calculate that stuff. We get you set up in that, and you can just enter your hours, and then they make the payment, they file the tax returns, and we can help with that. Missing deadlines. This year the deadlines have shifted all around. The April and June payments that we would make are now due in July. Every once in a while they'll change when things are due. A number of years back, they changed the when C corporations were due, and when some other things, the filing dates changed. So missing required forms, sending 1099s to people you're supposed to send 1099s to, or having certain foreign tax forms, which a lot of times don't generate tax liability, but we've encountered this year some people who had entities that were owned by foreign entities that should have been filing certain required forms, and the penalty for not filing those forms is $10,000 a piece per year. So, if in doubt, check with us, and we can kind of put you in a, at least give you an answer as to what's required. So, and I mentioned that, not trusting TurboTax to do it yourself. I mean, there's certain people who just have W-2s. I think they can get away with that. But if you get anything complicated, you don't want to be doing TurboTax. It does have a question. It walks you through. We just picked up a client who has been doing her tax return for the last few years, and when she did her 18 return, she put the income off of one schedule into the wrong form, and is cost herself about $15,000 to $20,000. So we're in the process of fixing that problem for her, because we reviewed her returns and told her that she screwed it up, and now we're going to go ahead and get that fixed, and hopefully we'll get that refund. It'll take a little while. Under the current circumstances, things are moving kind of slow at the IRS, but we'll get that resolved. But it's better to have it fixed than not cause that kind of problem by having someone who knows what they're doing take care of your filings. So the last, number 5, failing to plan. So here's my Ben Franklin quote: if you fail to plan, you're planning to fail. And I say it's a core mistake because it's the root of so many other things. The other way that we tend to say it around here is that failing to plan means you're planning to pay the IRS more than you really need to. So, you're not required to pay any more tax than you legally should, and not arranging your affairs in the proper way and overpaying your taxes is just a waste. I don't like giving the government any more money than we actually need to give them. So I'll point out in some of this planning, many of the best tax strategies expire on December 31st each year. So, we can't, do things like create new entities, after December 31st retroactively. If you weren't an LLC or an S Corp, I can't go back in time and form one with the state to make it happen. Retirement plans, sure, there are some plans that we can, when we're doing tax returns in February, March, or April, we can say, hey, you can still put money into this, or you can still do this. But really the better ones, the 401k plans, the solo K plans, the defined benefit plans, all of those have to be enforced before the end of year. And of course, you can't create payroll, retroactively unless you're prepared to pay a bunch of penalties on it. Usually it's not worth creating a payroll in order to do a retirement plan contribution if it wasn't all done before 12/31. So, it's really important to, decide that, this stuff is important. Why do people fail to plan? First some think it's included in their tax prep fee, and it's not. That doesn't mean we don't from time to time see somebody doing something and say, hey, you probably should do this differently. We do that all the time. But we find that when we do a full tax plan and we sit down and dig through the situation, and we start asking the more detailed questions, who are you supporting? Does your wife or kids, do they work in the business? Can we put them on the payroll and get some benefit from that? Is there anybody else that's helping you? And in a small business, a lot of time the whole family's involved, and maybe there's some ways to take advantage of that structure, or find out that there's other events going on, because really tax planning is all about either transferring income or deferring the income, and trying to find a way to deduct things that you're doing anyway if we can make it related to your business. So a lot of people don't see taxes as a pre-planning event. It's what they do when they bring their stuff in February or March to do last year's return. And I can tell you that accounting and most accountants are very historical in nature. They look back at last year, and we do tax returns for last year through about mid-October each year. So almost 10 months of our time is looking backward, and it is really difficult to be proactive and be looking, and we try very, very hard in doing that, to make sure that if we see something when we're doing last year's tax return, it may not be something we can help you with for last year because it's over, but it may be something we can point out that we need to do a plan. But it works best if someone comes to us and says, what can I do? Let's set an appointment and sit down and review my situation and see if there's something that we can do. And then we get to ask a lot more questions, because people tend to assume that we somehow know what they're doing during the year. Find out, they come in and we find out what they really did last year, which was something we didn't know anything about. Hey, I sold this, or I bought that, or I made some huge error. And we can't undo things like that. So make sure you ask us anytime you're making any large financial decisions. They don't think it's cost effective, and again, I point out in our tax plans, they're all based on return on investment, and if we're not going to save you money, we're not going to do it. I get the life is busy and they just never seem to get around to it, but some of the examples that I've given here today are it's $10,000 or more, and really you're okay sending $10,000 a year more to the IRS and not having to use in your family or add to your retirement or your lifestyle or whatever is important to you. It's if there's nothing we can do, we'll surely tell you, hey, you're doing your best you can. And we find it a lot of times it's really difficult to plan for people who are just wage earners. If all you get's a W-2, you can put money in your retirement plan. You can do HSAs. You can do or FSAs, type of plans through your employer. But, there's not a lot you can do if you're just a fairly simple scenario where you're getting a W-2. But, sometimes we find out there's more. Well, they got rental properties or they've got other kinds of investments. So, and really, I think the biggest reason that, people fail to plan is that, well, they don't think it's much fun as we do. So we really enjoy tax planning. We really do. We enjoy saving people money. We enjoy not sending it to the IRS, and we enjoy putting it back in your pocket. And, again, I'll give you another quick story. A client of ours took a big capital gain on a stock. He owned two stocks. One had a huge gain and one had a huge loss. And he went ahead and sold the one with the big gain. And he came in to see us, in February to do his tax return for the prior year. And, had he called us, we would have told him to sell them both, and the big gain and the big loss would have offset. And instead, he didn't do it and ended up paying a bunch of taxes that he could very well have avoided. And then going forward, all he had was a stock with a loss. And if he sells that, he gets $3,000 a year against his ordinary income for a very, very long time. And it just was, we see disasters every once in a while, and it's usually not communicating with us what you're looking to do and allowing us the opportunity to tell you, hey, here are some ideas. Let's do it this way instead of the way you're thinking. So, most of these big financial decisions don't always happen super fast, so there's time. And again, I mentioned that most of these things that we're talking about here today are not, I mentioned retirement plans a couple times, but that's not the kind of thing that, I'm really saying is the really good stuff. I like the tax planning concepts that are, cash flow positive. It's not, put $10,000 in your retirement account and you'll save $2,500. That's you still got to come up with an extra $7,500. But most of these entity structure things and, planning for things you're already looking to do are just gravy. So, and then of course, how can we help? And I said we get back to how we can help. So, we offer, proactive tax, minimization written plans, what we call tax plans, that we sit down, we review your situation, we determine whether, we need to change your business entity structure, a restructuring of that, or we need to change your salary levels, or we need to look at retirement plans. We go through all the little stuff, the vehicles and the home office and all those things, but those are not the big items. The big items that we find are usually problems with the entity, problems with the pay, and then of course making big mistakes by not checking with us on whether you can really do this thing without causing a major problem. Don't take a bunch of money out of your retirement account if you're not aware that that's going to get taxed. So, we also offer packages for real-time accounting, tax returns, and twice-a-year scheduled tax meetings. So, for our business clients, we're very big on getting you into a structured plan where we are working on your accounting every month, where we know where your business is year to date, and we can have those meetings usually in July and November where we say, here's where we think you're going to be, and get input from the client on what don't we know about what's going on in your business. Are you going to make a bunch of more money between now and the end of the year? Is it going to be about the same? Here's where we think you are going to be tax-wise, and here are some things we can do now during the year before the end of the year to reduce some of this. So again, most of the really good stuff you have to do during the year, and when you come to see us in February, it's too late for last year. And of course, we can always do, an a la carte planning or projection. We do those things all the time. Hey, Tom, I'm going to sell this rental property I've owned for 15 years. What's that going to look like for me? Should I do a 1031 exchange, or should I just pay the tax? And some of that we're look at our tea leaves and deciding whether we think the tax rates are likely to go up or go down. And again, I've said it once or twice already this year, for this year we do have an election coming up in November, and I'll have a whole lot better feeling for what I think taxes are going to do when we get past that date. But that's in early November, so we've got a month and a half to make any plans that we would need to. Same thing, comes into play when we start talking about estate and transfer taxes. So, if you've got money and you're likely to get hit with the estate tax, there are things you can do now to start putting that money aside for maybe for the next generation. And, sure, not everybody wants to do that. And I've seen those things offered to people who I thought were way too young to be planning on giving their money away, because either they were too young and they didn't have enough of it, or I knew they were going to need it in retirement, and I wasn't a big fan of them giving their money away. But you get a little older and you get a little wealthier, then those are things you kind of start looking at. So, bottom line, I'm very proud of our ability to save taxes, and we can't read your mind. So, help us help you, and give us a call if you need some help, or if you're not sure what to do, or what how something's going to affect your tax burden. That's our expertise area. So I think at this point, I'll see, does anybody have any questions? I go here to the chat box. I see I had some problems obviously at the front end of this thing getting it started. I'm sorry about that. And again, most of the time the tax questions that we get are very personalized. So I understand that we may feel free to email me or follow up if you've got a specific question about a transaction or your structure. We really do a lot of times tell folks both, hey, you need to be this entity, or you don't need to be this entity because you're spending more on doing tax returns for this thing every year than you're really saving. And sometimes people have great plans and hopes, and they'll continue that entity for a number of years before they kind of throw in the towel and go back to doing it without that level of complication. So, all right, well, seeing as we don't have any other questions, I will wrap it up and just say, thank you for attending. I hope you found this valuable. If you have any questions in the future, please reach out and give me a call, and everybody have a great day. Thank you.